Happy solstice, everybody. It's Austin at Homeowners Financial. Okay, so it's not really a credit card. We're talking about credit. It's actually handleable coffee. Delicious coffee. Anyway, so we're talking about credit. Now, yesterday I did Monday Mortgage Minutes on 5 tips that you can do to reduce your budget. And really, your credit is a huge way that we can manage, not just for scores and opportunities, balancing debt, but we got to make sure that it's giving you the opportunities you want for everything else down the road, because what we do today matters for them. So I want to give you some tips around credit. How are scores derived? There are 3 bureaus, 3 credit reporting agencies, and each one has different modules, 8 to be specific, for the different type of report that's being requested. So therefore, 3 times 8, 21, there's 21 different scores out there. And this is a big reason why your Credit Karma score or the score from your credit card or your bank can be different than what we pull, because they're weighted differently. When we look at scores overall, it is the history of time, it is the repayment history, and it is also the capacity. So capacity is a huge, huge thing. 35% of our score is payment history, but then 30 of it is capacity. And what is capacity? That is your balance to limit ratio. So if your limit is $10,000 and you're spending $10,000, you're at 100%. If you spent $7,500, you're at 75%, $5,000, 50%, all these different things. And each one of those has a ranking. The more credit you have available, the better it is. So I always say, like, the angels sing at 19% balance to limit ratio. So 19%, 25, 33, 50, 75, 100, and then over 100. This is also very key, because what I just said is if your limit is under the amount you owe, or the amount you owe is over the limit, that's going to be poorly impactful for your score. So think student loans, right? When you defer the interest in your student loans, you can owe more than the actual original amount that you were lent. That will impact your score. If you overspend on your card, that will impact your score. So we have payment history, and then we have capacity, so the balance to limit ratio. The next thing is what's going to be called depth of credit or age of credit. So this is really for how long you've had credit. So think of it this way as well. You don't want to be that person that nobody ever hears from, right? So if you're opening a new credit card and closing the last one, you're like a serial dater, man, right? You're just using these things. What you'd like to do instead is have 3 or 4 trade lines, different entities, your Amazon, your Marriott rewards points, your travel rewards cards, a student loan, whatever, those 4 different types of trade lines, and as old as possible, at least 2 years. So yes, if you're in your 40s like me, I've had credit for over 20 years, and I still have one of my credit cards that's been open since I was 18. That is 24 years of credit depth. Whereas Jenna on the team, she's in her 20s, she hasn't had credit for 20 years. She hasn't had credit since she was 5. So her score is going to be probably lower than mine simply from that fact. So again, we have payment history, of capacity, we have length of credit, we have mix of credit, and then we have new credit. Now these are only 10% each. They're not super impactful necessarily from your scoring. Mix of credit is the types. I gave you the example where you had 3 credit cards and 1 installment debt. Well, you'd have 3 revolving and 1 installment. Is it a mortgage? Is an installment debt like a car loan? Is it a revolving debt? Is there different capacities that are reporting? So that's the mix of credit. Fun fact, that used to be more like 20% of your score, and they realized that that's not necessarily relevant of how people pay. So now it's only 10% of your score. And then the last 10%, again, is inquiries or new credit. And this is what you think of, like, oh, my credit score is going to drop if you run my credit. Well, it will be impactful, but not as impactful if you are paying your bills on time, you have the right mix, right? And you're not using things drastically. So we're looking at scores, again, there's 3 bureaus, 8 algorithms per bureau, therefore 21 different modules out there. We want to pay things on time, we want to not spend over our limits, we want to make sure that we're leaving things open, not just constantly closing and constantly closing. Inquiries are not that big of a deal unless you're doing them all the time, and the mix of credit. So hopefully that gives you a little bit of insight as well. I do have credit classes on this channel, and if there's anything I can do to help you or anyone else, let me know. It's Austin at Homeowners Financial. Make it a great day.